Hey, earlier this week, I sent out a text message asking if you wanted a video, and I did it as a poll. It was interesting. I had a whole bunch of people asking for the 6 tips to reducing stress. So I'm going to get back to you on that one, but seemed like the majority of folks really wanted to get some sort of a market update, and I wanted to share that with you today. So if you'll permit me to do so, I'm going to share a screen here real quick and see if I can't just bring a little bit of focus on what's been going on with the interest rates. So what the heck, what to think about the current and the future interest rates as we move forward. So I wanted to share with you just a couple of key points. Some of these you've heard people talking about, but I just want to put them back into perspective. If you want a deeper dive or if you want any of these graphics, I'm more than happy to share them with you. But this video should hopefully put out a couple of things for you to at least bring into your conversations with the clients that you're working with. So again, here's just that view. You may have seen this before from the Federal Reserve Economic Department. This is a view of the Freddie Mac rate since 1971. So you can see obviously way back in early 1971, right around 7.5%, and we saw those rates go up to 17.5%. A lot of people even talk about 20% interest rates, but I don't know where they were getting those. Somebody must have been overcharging them. But we could see that steady decline from the recession that happened back in the mid 80s. We can see there was a peak in interest rates, and then slowly that has just continued to drift down and down over time. Now, since COVID, we wound up having the lowest interest rates in the history of tracking the interest rates since 1971. And those interest rates, we were hearing rates down in the twos, right? 2.875, 2.625, things like that. And then when COVID hit, and a couple of things crept into our picture, some geopolitical issues came out that have really put a strain on our interest rates. So we can see those rates right in the beginning of January 22. Inflation started becoming a fear. And with inflation, the government finally stepped in. They took a long time to do this. They should have probably started earlier, but they needed to start hiking interest rates to control the inflation and get ahead of it. Once they started, it was a runaway to the races on the interest rate. So they started increasing and doing 0.5 point. And then most recently, the last 2 Fed funds rates were up 0.75 point. And right on top of that, we had the war in Ukraine, which obviously continued some supply chain issues and brought other concerns for the global economy that have really impacted the world, not just the United States, but the world. We're hearing conversations around a world recession, not just something here in the US, but worldwide issues. So that war in Ukraine certainly put an impact on things. And then we've been watching our employment numbers. Now, employment still seems to be really strong. And if the employment numbers weren't as strong as it is right now, we would certainly, most certainly be in a recession. So as we continue to watch this, there was some numbers that came out today. This is a scene, it says since the start of COVID, but really this is just this most recent week, October 3rd through October 7th. We started off the week, interest rates actually got a little bit lower at the beginning of the week, and then we've seen them by Tuesday afternoon, and then Wednesday, Thursday, and today, we've seen those interest rates come up. And that's because just again, back to that geopolitical situation, we've got OPEC, who is going to release fewer and fewer barrels of oil. That's going to put a strain. We're going to see gas prices continue to increase, which hurts our inflation numbers. And then we are starting to see hints of the employment shifting from a growing economy where we have people, all jobs are being filled. We now have some vacancy. We have more unemployment that's starting to creep in, and that's going to be the beginning signs of that true recession as they're going to define it. So what do we think, and how do we guide the people that we're working with? And I really just want to say, communicate more frequently with the clients that you're working with. The more frequently you can talk to them and get them comfortable with the change in the housing prices, you can get them comfortable with the change in interest rates, that's going to make them more confident in their decisions on how to move forward. So we've got to present more options. Perhaps it's looking at more homes. In my respect, it's going to be talking about different loan programs. Everything's not a 30-year fixed. We're doing buy downs, 1-0 buy downs, 2-1 buy downs. We're doing permanent buy downs. Those are all things that if you're not truly familiar with, give me a call and I can walk through the economics around those. But we're also looking at 3, 5, 7, 10-year adjustable mortgages. We're looking at 40-year loans with a 30-year amortization. So there's just a lot of different options. We even have a 6-month adjustable for that person who really wants that low start rate, knowing that they have a specific scenario of what they're trying to achieve. Perhaps that's the right answer for them. So we've got to address both the short-term and long-term goals for our clients. So short-term, let's get them into these homes. Let's look at the opportunities, right? There's less buyers out there. They have an ability to negotiate. We just got to get them in the game and get them thinking about the future. So the old phrase, right? Marry the home, but date the rate. I'll work on interest rates. You work on finding them the right house, and together, hopefully we can find a good solution. So here's my contact information. My cell phone is always the best way to get me, but you'll see a new email address. It's carl@strikerteam.com. And I welcome you to use that. Reach out to me if I can help you or your clients. Please don't hesitate to give me a shout. I would love to work with you one-on-one with some of your clients and just give them the confidence and insight and education to make a solid and confident financial decision through home ownership. Thanks so much, and I'll look forward to speaking to you here sometime real soon. Bye-bye.